Stop trading based on gut feeling and start reading the market's true emotional temperature using artificial intelligence. What if I told you the next major stock move is hidden in millions of tweets, news articles, and confidential forum posts? This isn't just about technical analysis. It's about decoding the collective human mindset before the price is fully reflected. Today, we are diving deep into the AI technology that quantifies this psychology. Sentiment analysis. This methodology allows sophisticated hedge funds to find alpha in noisy markets before conventional analysts even finish their reports. Understanding the why behind volatility gives you a decisive edge over those focused solely on backward-looking charts. Welcome to the future of trading, where psychology meets machine learning at unparalleled speed. At its core, sentiment analysis is the computational identification and categorization of opinions expressed in text. Traditional sentiment was crude, often binary. Modern AI uses granular scoring on a continuous scale of -1 to +1. We are hunting for polarity, but also for subjectivity, determining if the statement is fact or merely personal opinion. For instance, a simple price change report carries neutral sentiment, regardless of the direction. However, statements like "this stock is ready to break out," "massive potential," carry strong positive opinion. The core intelligence comes from highly specialized financial lexicons combined with machine learning classification. These lexicons contain thousands of words weighted specifically for capital markets. Liquidation is drastically negative. Acquisition is positive. This prevents the model from misinterpreting colloquial speech that might confuse a general-purpose model. We must also train the models rigorously on negation and intensifiers, such as understanding not a major problem as slightly positive. Where does the AI find this torrent of emotional data? We scrape social media, news, blogs, and regulatory filings constantly. Social media, especially platforms like X, provides immediate high-frequency signals reflecting the retail investor mood minute by minute. However, social data is inherently noisy and requires aggressive filtering to remove spam, bot traffic, and non-financial discussions. We use credibility scoring based on follower count, engagement rate, and historical accuracy to weight individual tweets appropriately. News articles offer a more structured, but often delayed, institutional viewpoint, which drives longer-term momentum. Our models prioritize sentiment shifts in headlines and the introductory summary paragraphs of professional analysis. We also deploy proprietary scrapers to pull and analyze earnings call transcripts and investor Q&A sessions in real time. The subtle vocabulary used by executives can reveal hidden operational stress or unexpected enthusiasm before it is quantified in financials. Even regulatory filings like 10-KS are scanned by AI for subtle changes in mandated risk disclosure boilerplate language. Integrating these diverse, high-volume data streams ensures we get a holistic 360-degree view of the market's psychological state. The core engine powering this complex interpretation is natural language processing, teaching the computer to truly read human text. We begin with tokenization, where text is broken down into small, semantically manageable units called tokens. Advanced models, specifically transformer architectures like BERT, are essential because they understand the contextual relationships between words. This handles ambiguity. The phrase "shorting the position" has a vastly different meaning than "shorting cash flow" for the quarter. Transformer models allow the AI to simultaneously consider all other words in the sentence before assigning a context-aware sentiment score. Once text is quantified, machine learning models take over, usually supervised learning algorithms requiring massive amounts of labeled training data. We often employ specialized recurrent neural networks, particularly long short-term memory, or LSTMs. LSTMs excel at processing sequential time series data, making them perfect for analyzing continuous sentiment readings over time. This helps us prevent concept drift, ensuring the AI adapts as market jargon, slang, and effective emotional words change over months and years. If we fail to adapt, our models might completely miss the next coordinated retail frenzy or the latest financial buzzword. To reduce variance and boost reliability, we use ensemble methods, combining predictions from several specialized models. Only when multiple, Independent models confirm a synchronized emotional shift. Do we generate a high-confidence, actionable signal? Raw sentiment scores are meaningless unless you can quantify their predictive power through rigorous backtesting. We must establish a critical action threshold. Is a score of plus 0.6 bullish enough, or do we require plus 0.8 to initiate a trade? Our primary use case involves contrarian trading, capitalizing on extreme emotional divergence between groups. Extreme retail euphoria often marks a market peak, signaling that everyone who wanted to buy has already done so. At this point, the smart money steps in, taking the opposite side of the emotionally exhausted retail crowd. Conversely, deep, widespread despair, often signaled by highly negative sentiment, can indicate a major undervalued buying opportunity. Sentiment must confirm existing technical signals for a higher probability setup. We never trade purely on mood. For example, a strong buy signal requires a technical breakout confirmed by rapidly increasing positive institutional sentiment. Sentiment is key for dynamic position sizing. Higher conviction signals allow for larger capital deployment. If the sentiment signal is mild, we allocate minimal capital. If it hits extreme, we take a high leverage position. Furthermore, sentiment provides an excellent early warning system for risk management and aggressive trade exits. If news sentiment suddenly turns neutral on a positive position, it signals fading momentum regardless of short-term price action. Exiting based on decaying sentiment often protects profits before the actual price drop occurs, perfectly preserving capital. Real-time sentiment feeds are integrated directly into our proprietary execution systems for algorithmic response in milliseconds. Despite the immense power, AI sentiment analysis is not a perfect oracle. It struggles significantly with human nuance. The biggest failure point is detecting sarcasm and irony, which can completely flip the intended emotional meaning of a phrase. Our robust AI systems must include a dedicated irony detection layer, trained on cues like emoji usage and excessive punctuation. Data poisoning is a critical threat, where malicious actors flood social media with fake, coordinated sentiment to trick weaker models. We mitigate this using source credibility scores and advanced cluster analysis to identify unusual data density. Market events are often driven by unpredictable exogenous shocks, such as geopolitical crises or unexpected policy changes. Sentiment will reflect these shocks rapidly, but it cannot predict the initial event itself. It only measures the collective reaction. We must also address the lag effect. Price action can drive sentiment just as much as sentiment drives price movement. If price drops dramatically, sentiment will instantly follow. But the model needs to distinguish this reactionary lag from a true predictive signal. Despite these challenges, the ability to rapidly aggregate and quantify human emotion remains the ultimate trading advantage. Consider the Tesla or GameStop short squeeze events, where traditional valuations screamed sell. The AI sentiment models, however, detected persistent, coordinated, highly aggressive positive retail sentiment that overpowered fundamental models. A truly refined system doesn't just read mood. It identifies which group's mood matters most for the specific asset class being traded. For a large technology stock, institutional analyst consensus usually carries a far more weight than general social media chatter. For pharmaceuticals, research publication sentiment and FDA filing commentary carry the highest predictive impact. Building this predictive emotional engine requires massive computational resources and specialized data science talent. But the returns on identifying these emotional turning points, where fear or greed peak, are generational and justify the cost. Sentiment analysis fundamentally shifts the focus from backward-looking charts to forward-looking psychological momentum. If you're still relying on chart patterns alone, you're missing half the story, the emotional half that moves capital. Mastering AI sentiment means mastering market psychology, leveraging the human element against itself for profit. Now, I want to hear from you. What is the most emotionally driven stock you have ever traded? Let me know your thoughts and experiences in the comments below. Don't forget to like this video if you found the technical deep dive useful, and subscribe for more quantitative finance secrets. And remember, the signal is out there. You just need the right machine to hear it.